$100 last January, and you can see how small these market caps have now gotten. With cratering valuations, is the online retail space due for a round of deal making? Joining us now is Jan Kniffen of J. Rogers Kniffen Worldwide. Jan, how do you think the story plays out?
Well, remember, this DTC retailing may be an asset-light business, but it's really got low barriers to entry, and it really benefited from all that money the government put out there, just like you said, to the consumer. And the market share doubled for online over the time period. So they were really benefited. And on top of that, money was free and it was freely available. Now all of that's changing. So I'm not surprised they've all been crushed. I realized when I sent you notes about this, I said, they've been cut in half on valuations. A lot of them have been cut by 75 or 90% on valuations.
And the lack, I was going to say, the lack of noise around them is quite telling. I mean, I wonder, it brings up a point Simeon Siegel had made a couple of months ago over at BMO, which is this business model broken? Is wholesale, the fuddy-duddy old wholesale, for instance, a stronger business model? I mean, what kind of pivots should we expect to see here? Because it doesn't right now look like there's a lot of suitors bidding.
Well, remember, there's never been a lot of profits made in this area when you look at small DTC players. I mean, yeah, there's some great names like Allbirds and Warby Parker and Bombas and Adore Me and Everlane and Mack Weldon, Tommy John, all of that, those companies, Third Love, even Stitch Fix. I mean, they had a good run too, right? But it wasn't driven by profitability in most of those cases, probably all of those cases. It was driven by the fact they could really grow. And money was cheap, and so that all worked. Now we look at it and we go, well, maybe it matters if you make money or not and what the profitability looks like. And a lot of these guys, they all started as DTC only, but like Warby Parker, they're just a retailer today.
Right.
They do a lot or almost all of their business now out of the stores, but they really support it with that online presence. And that's true for all of these too, even the ones that are built in stores. But I think, yes, it's time. Like, shouldn't really Mack Weldon and Tommy John be one business? They've got the same customer base. They've got barely scratched the surface on market share. So it's not like the addressable market would be a problem. And they could eliminate a lot of overheads and be stronger. And they may want to be stronger and easier financed going forward. And that could be true for, like, Adore Me. You could marry them up with Third Love, and maybe they'd be a stronger business together. We may start seeing some of that stuff, but we may also see some of the big guys step in. Yeah. You remember back when Walmart bought Bonobos?
Yes.
Well, they could buy other ones. Target could buy some of these brands.
But did that go well for them? I mean, what's the track record here? And I just love the irony of how the tables have turned. I mean, the sexiness of all of these startups, and now we're looking to suitors as, oh, maybe Walmart and Macy's can come to the rescue. It's very interesting.
No, the answer is you're right. None of it have gone well so far. But we all know they need these brands. I mean, wouldn't Macy's love to own some of these cool brands? Wouldn't Nordstrom's love to own the brands? But what about VF and PVH? Right. Wouldn't they love to own Allbirds, for instance? I mean, those brands have been built into equity value in the customer's mind. And so I can see why they want to own them. And suddenly, if you can buy them at 75% off, 50% off, don't they have to be saying, if there's ever going to be a time, now's the time?
Final question, though. Are these companies profitable enough? I mean, at a time like this with inflation, supply chain pressures, pressure from Wall Street for stock performance and all the rest of it, are they going to turn and say, you know what, now's the time to bolt on what may still be an overvalued and not very profitable, but very cool startup? I take your point. They have a lot of sort of equity brand value, but can the suitors afford to take that risk on right now?
Well, let's take the other side of that. What if you're Amazon? You could buy all of these, and it wouldn't make a blip, even if it was highly dilutive. You'd get these great brands, you'd get the growth you wanted, and you'd get paid for it if you were Amazon. Right. So they would be willing to buy some of these brands. They've been building private brands. They want stronger brands on their site. They're the kind of company that could do this and never bat an eye. Walmart could too if they wanted to, obviously. They're big enough it would never affect their bottom line. We'd never see it. But you have to believe in the future. But if these equities brands in people's minds are worth something and they'll build traffic to your site, that's worth something if you're Amazon or Walmart. You can get a lot of fall away fall off business from that, right?
Very interesting. Well, now we know at least some of the chess pieces to watch, shall we say. Jan, thanks for joining us today. Appreciate it.
Sure.
Jan Kniffen on e-commerce.